Across the financial service sector, long-term stability is shaped not only by regulation and capital, but by behavior. The way organizations design and administer compensation can play a critical role in influencing decision-making, managing risk, and supporting sustainable growth. We're here at the annual gathering in Davos to collect insights and ideas from CEOs from around the world. And joining us today are Wolfgang Schröter, Chief Executive Officer of EWM Global, and Daniel Max, Global Head of Financial Services at TMF Group. Daniel, Wolfgang, nice to see you both. Welcome to Davos.
Thank you.
Thank you. Thank you, Andrew.
Now, there is an acquisition story here to talk about, but let's deal with the subject matter first. Wolfgang, why is it so important that companies get their compensation schemes, operations right?
We live in a time when companies increase their controls, put more policies in place, put more emphasis on risk teams. We believe people respond, react better to incentive structures than to policy statements. Now, that doesn't mean that there's no value added to risk teams. Absolutely there is, and you must have controls in place. However, a well-structured compensation, incentive compensation framework will mitigate excessive behavior and promote prudent risk-taking and long-term value creation.
Now, we all think of companies as being in control of their own arrangements as far as that's concerned. What does your platform offer to your clients?
So we design, implement, administer complex compensation incentive structures. We do that via an IT platform, a very flexible IT platform that digitizes the processes and the data that goes into these complex structures. We have a team of very experienced employees that have been with us for some of them for 20 years. They support the platform. The platform is doing the heavy lifting, but it is supported by a team of very experienced and skilled employees.
For any clients that come to you, they're going to want to see what? Security, transparency, they're going to want to
see...
So
the platform creates basically a very streamlined data flow. It creates basically stability for the company with transparency to the employees about their compensation. It is an end-to-end process that we cover from sourcing the data to the payout to the employees.
I mean, Daniel, it all sounds very complicated, but I think complicated in this case is good, isn't it?
Well, I don't think there's much choice. I mean, companies might strive for trying to simplify their arrangements, but they're really led by what happens in the rest of the market. So what we find is now increasingly companies end up with a myriad of different structures. So they'll have carried interest, co-invest, equity, cash plans, and these need to be administered comprehensively. I think the problem also is that they might have a single person or a small group of people within their company that are doing this. That's quite a big risk to have a key dependency on a small group of people. So we offer a solution where they can outsource that to a third party, and that's really all we do. We do that work, and we can come along and help them to make sure it's conducted safely, as Wolfgang said.
But do you think there's a tangible sense that the company's operations improve once they outsource some of this to a company like yours?
Yeah, absolutely. I mean, I think if you look at, we can look at all the different arrangements that we work on for many, many different companies. We can draw the best of our expertise across that piece. So we can provide them with a sense of stability and security that it's being affected in a way that is compliant with regulation, but also something that gives them real control and access to the data they need to run their company.
Looking at some of your literature, Wolfgang, I've seen that you impress again and again that it's important to remember there are three stakeholders in this. That there's the owners, of course, and then there's the employees, and there's also public interest. Explain a little bit about why those are so important.
Public interest, as Daniel just mentioned, is specifically if you have the right compensation structure in place, you adhere to the regulation, you make sure that there is no excessive risk behavior, that creates stability in the companies, and that obviously increases the trust of the public in financial services. Now, the owners are obviously concerned about long-term wealth creation, long-term value creation. With the right incentive plans in place, you do achieve that. And of course, the employees. The employees, we are not in a time where you pay out the profit just to one person or to a handful of people. There is a whole team that achieves that profit. And through the right compensation structures, you make sure that there's an alignment between contribution and reward.
Is there a vision in this? I mean, what drives you to make this work?
Actually, that is the vision. We do think from the beginning, we have felt that you need to ring fence compensation in a way that it is structured fairly, that it is accurate, and that it is obviously in line with the shareholder values, with the shareholders' views, with the public interest. And when you do the right compensation structures, you achieve that. And that is our vision. And obviously, we want to do that around the world. And that is why now with a bigger company, we can do that everywhere in the world.
I think it's an interesting point as well. I mean, we've seen over the years that I guess a long time ago, it was just a few people in some of these funds that were receiving some form of additional compensation through profit sharing. And as we've seen time's gone on, many more of the executives within a firm, sometimes up to half or even more, are involved in these arrangements. And that, I think, is a good thing. As Wolfgang said, you're seeing that there's an opportunity now for the wealth that's created not just to be the domain of a few founders or a few people that sit in the very most senior positions, but it's really diversified across a much larger percentage of the population.
But it's interesting. It would be tempting for me to think that all you're doing is policing that operation, making sure the company does it straight and doesn't get into trouble. But actually, it seems to me also there's a possibility you're pushing or nudging a company in the direction that for its own good, it can do this in a more equitable way.
Yeah, absolutely. I think that's got to be the actual outcome here, is that we are to some degree with police, and we have to make sure that the regulation and the environment are successfully followed. But also we're looking to make sure that companies can get the very best out of these structures, that they can deliver the best shareholder value, the best value back to their investors, but also for the good of their employees, to make sure that those that are really contributing are recognized in that output.
So we have seen over the last, and we're doing this since 25 years, we have seen over the last decades that management very often has the right intention to put the right plans in place to mitigate the risk of excessive behavior. But when it came to the execution, to the implementation, to the administration, it became such a burden that they shied away from it. So they had the right intention, but they weren't able to execute on it. So we came up with a way to basically allow them to outsource that headache, that burden, that administrative burden to us. Let us deal with it. And then you can have a plan in place that actually does what it's intended to do.
I've got to ask you very quickly, you've said it a few times now, excessive behavior. What is that?
Excessive behavior is if you have short-term thinking, if you just focus on your quarterly profit rather than long-term value creation.
And also, while we're on the kind of vocabulary issue, what's end-to-end integration?
End-to-end integration, meaning let's take a private capital firm. So we do the administration mainly for investment banks, wealth managers, asset managers, private capital firms. In the private capital firms, you have, for example, carried interest plans where people long-term participate in the profit of a deal. Now, this data is being created somewhere else. It's not in the GP, it's created in the fund administration. TMF does fund administration. We take the data through a waterfall, comes to our platform. Then after years, when the payout happens, after all the data management, when the payout happens, it has to go to a payroll. TMF has payroll. So you see an end-to-end integration of all the processes and a seamless data flow.
Briefly, we did mention acquisition at the start. Is there anything you'd like to add about that, Daniel? The acquisition relationship that you have with EWM?
Well, it's been a great marriage. About a year ago when we came together, and of course EWM had been operating with global clients for a long time, but with a relatively small footprint. TMF Group, we've got offices in 90 countries, and so what we've been able to do is marry those two pieces together, the best of both worlds. It actually carries on a little bit from that end to end as well. So where the focus of EWM is around the compensation, we can now look at a wide myriad of different services we provide to, for example, an asset manager. We can do a lot of different things, join that together, remove some of that operational tax of lots of different providers being involved by, I guess, operating in a way where we can do different things, whether it might be the fund administration, it might be the payroll, it might be the compensation, it might be compliance services. Just gives our clients a little bit more opportunity for us to just expand one single provider for them.
Final thought then, and I'll come to both of you on this. I'll start with you though, Daniel. It's getting more complicated. I think it's going to start getting even more complicated perhaps as we get down through the corporate world, as we progress on through the century. What do you think is coming down the pipe, and are you ready for it?
Yeah, I mean, I think it is going to get more complicated. We've been doing this for a long time. In TMF Group, over 30 years, EWM, over 20 years. It is what we do. So, we leave our clients to go and worry about the process that they're employed to go and do. The investors that put money into our customers, our clients, for example, they're wanting to get great returns. So we take away that burden of having to worry about the administration of it. And as I said, that's really all we do. It gives us the opportunity to make sure we're best in class for that, and that we remove some of the pitfalls, the hurdles, the risks associated with that.
I call it data ping pong. When data is being created somewhere, it goes into a spreadsheet, goes back into another system. That is what we have to eliminate. And with the integrated approach, we can eliminate that. And we look forward to doing that.
Splendid. Daniel, Wolfgang, thanks very much for joining us. Good to talk to both of you.
Great.
Thank you. Thank you, Andrew.
As financial institutions continue to scale globally, managing complexity without increasing risk has become a defining challenge. EWM and TMF say that transparent, well-governed incentive structures are essential to support responsible growth, fairer outcomes, and long-term stability. It allows organizations to focus on strategy rather than what they call the operational burden.